Hello class and welcome to the first video on budgeting. This is chapter 13 in our textbook. I will have the homework questions assigned today, so you'll be able to go in and get started on them. Today we're going to go through some budgeting for the income statement, and in the next video we are going to go through some budgeting for the balance sheet items, basically budgeting for cash. We can do our accounts payable, accounts receivable, that types of thing. And then we'll do some practical budgeting applications in the second video as well. But so let's get started here and talk about what budgeting is. Basically, budgeting is just a plan that a company is going to come up with beforehand, stated in financial terms of how an organization is going to operate and how they're going to achieve the goals of the company. Okay, what we are going to create in this chapter is called a master budget. Master budget is basically, it's an overview of everything, as I said, from the income statement to the balance sheet. So if you're looking at maybe just the master budget, you might just see the front page and you will see the ending income statement and balance sheet, but there are a bunch of different smaller little budgets that we'll go through that you have to create in order to get to them. So what I have up on the board here though, here's what a master budget's objective is. Okay. First, it has to meet the organizational goals. It's going to explain in financial terms how to meet the organizational goals. Second, it has to have a strategic long-term plan in it. Okay. That comes with the cash. When we start looking at the cash budgeting, okay, how they're going to maybe budget to buy PP&E in the future. Okay. When that comes up, making sure they're having enough cash on hand to do that, managing their receivables, managing their payables to make sure they're not getting too much in debt, stuff like that. That all meets into the strategic long-term plan. Okay, and third, tactical short-term objectives. That's going to fall more on the income statement. Okay, we're going to do cost of production budgeting and stuff like that. So those are going to help meet short-term objective, getting the net profit and the cash flows that we need for the short term. All right. There are some problems associated with budgeting. One of them is a major ethical and somewhat of systematic how budgets are created issue. I don't know how to better word that, but it's manager integrity. You're going to be you're going to create a budget. You're going to have to get a lot of input from your managers because there's a lot of estimating that goes into budgeting, which is the second downfall. But so in order to get that, you're going to talk to lots of different people, and you're going to have to assume that managers are going to have the company's best interest at heart instead of their own, which is not always the case. Okay, managers are always going to be fighting for increases in their budget. They're going to say they control costs here, but they're going to need money here, and it's always going to be essential. So if you're top management, you have to fight that. On the other hand, if you are on the lower management, maybe middle management, and you're fighting with upper management, sometimes it's hard to get that stuff for your budget because they are going to try to keep their budget as tight as possible. Okay, so you have to have some good reasons. So there's always a fight on what goes on there. And another big thing, just when it comes in the practical world with budgeting, a lot of budgets are based off of the previous year. So if you have an operating budget for your department of $1 million, and then it comes at the end of the year and you fell in at 800,000, so you're 20% under budget. Great job, right? You might get a nice big bonus for that. But then probably the next year they're going to look at it and say, well, if you ran at 800,000, you can run at that again. So your budget just got slashed by $200,000. So what if you had a big expenditure? You had thought about, I'm going to run a tight budget. I'm going to run this. I'm going to save this. And maybe you've talked it over with your immediate supervisor. You're like, yeah, run under this budget. We won't cut you, and that way next year, maybe you have the same budget, but you have a little bit in savings and you can make this big expenditure that you want. Well, upper management doesn't know about this, or maybe they disagree with your plans or whatever. They see that you ran that a tight ship and you ran 800, so now they expect it all the time, so they cut your budget. I've known managers, and it's not uncommon for managers to make unnecessary expenditures at the end of a period in order to use up their full budget in order to not to get it slashed. So that has definitely becomes a problem of budgeting. Second is the estimating info. As I said, sometimes it is really hard to estimate information. If you're going a month out, maybe it's not so bad, but if you're trying to estimate a whole year on what your cost of a product is going to be, especially if you're using a commodity that fluctuates greatly in price, so that can be very, very hard to get accurate estimated info for a long period of time. with the advent of technology, that problem is somewhat became eliminated because if you create budgets in Excel, you can leave so many variables as components of formulas and stuff like that, such as selling price or selling units or all these different variable things. So you can go in and constantly just kind of change them. Maybe your rate of return, okay? And then just pop in the numbers for you. But as far as we're concerned, we're just going to keep with simple numbers on this and create a master budget. Before I get started on that, also know it is also known as a static budget, a budget plan, a planned planning budget, many different names for the master budget. But as long as their budget is meeting these three goals, it is the master budget. Okay, so let's break down into the first parts of budgeting for the net income statement. Okay, our first one is our sales budget. Enough. The sales budget, it is the easiest one to calculate. Sales units times sales price gets us total revenue. And while it's one of the easiest ones to calculate, it is definitely one of the hardest ones to estimate. Sales, calculating and figuring out how many units you're going to sell, very difficult. Use many different tools when you're an accountant, okay? Some of the stuff we've done in the past, you're going to pull old financials, okay? Look at maybe some trend analysis. How are sales going? Are they increasing? Are they decreasing? Are they holding pretty steady? Look at some market and economic trends. Is the economy kicking up? Is that likely to increase our sales? Are we in the middle of a downturn right now? So people are going to be a little tight with their money. It might retract our sales a little bit. Okay. You're also going to talk to your sales staff, your marketing managers, your production managers, and all that stuff. And you're just going to come up with a unit number. Okay. And you're going to know what your selling price is, more than likely, unless it's a new product. And you can even, that's a variable too. So these would both be variables if you're making kind of a flexible budget. So I'm going to go through the example and I have it on the slides to go through all of these. But from talking to all these people, studying the trends and doing all this, we've decided that we are going to sell 240,000 units next period at a total of $30 for a total revenue of $7,200,000. Okay. So you have some homework questions. You have one homework question where you're going to have to do a sales budget, and figuring out the sales unit is what's going to be the challenge. Okay, it's going to tell you sales are going to increase a percent by this amount, but decrease a percent by this amount. And maybe the price is going to change because commissions change, so they're going to raise the price. Okay, so you're just going to have to work and calculate through those and find out the sales unit times the selling price gets us our total revenue. That is step number one of the master budget for income statement, is do a sales budget. Our second step in the master budgeting project for the income statement is to do a production budget. And this is where we're going to find out how many goods we're going to have to produce during the period. Okay. So start with our expected sales. We just figured that out in the previous one before. Step one, we expect to sell 240,000 units. Okay, so marking this that everything we're doing here is on a unit level. We're not worried about the dollar amounts yet. Okay, so our expected sales are 240. We were also told in the problem that management wants 30,000 in the ending inventory, and our beginning inventory had 20,000. Okay. So that information was given to us. All right. So we're going to take our expected sales plus our desired ending inventory. Remember, we're budgeting. So we expect to sell 240,000. We wish to have 30,000 at the end. So our total needs are 270,000. Okay, we can subtract out our beginning inventory, 20,000. So you can see we need to produce 250,000 units of product for this period in order to hit our budgeted sales and what we desire in our ending inventory. Okay, so there is the budget for step 2. That is your production budget, expected sales plus desired ending inventory, get you your total needs. This is also on slide number 2, but I don't think that's right. It's probably slide 12. Okay, it gives you one in an Excel format on the PowerPoint presentation, which I have on Moodle. Okay. Pretty straightforward with the production one here. Okay, but that's the number we're going to need to go on to number 3. Number 3 is our direct material budget. All right, this time we are given some information here. The product we are making, I just wrote F and M, it'll be on the slide. So I believe it's like fabric and metal. Okay, so it gave us some information. The direct materials used per unit. Okay, so for the fabric, it used 3 yards of materials per unit. And for the metal, it used 2 pounds. Okay. We have beginning inventory, ending, and a cost per unit. So our beginning inventory for the fabric, 10,000, ending was 15, and the cost per unit is $2 per yard. Over here we had 1,000, 1,000, and $1 per pound. Okay, so that is all our given information. If you look at it as given on the slides, and that is the information you're going to need to make a direct materials budget. So we have how much we use, how much direct materials are used per unit, our beginning inventory, our ending inventory, and the cost per unit. Fabric in yards, metal in pounds. Okay. So we need to produce 250,000 units. We're going to again break this into 2 parts. This is now our budget. Okay, we're going to use this given information. I'm going to make the budget over on this side. Okay, I put the direct materials per unit up here because it is on the slide. This is slide number 16. That way it makes it a good flexible budget because we can put this in the cell 250,000. Okay, so we need to produce $250,000 and each one is going to take 3 yards. So we need 3 times the 250 or $750,000 in production needs. You do the same thing for the metal. 250,000. We need 2 pounds per unit, so we need 500,000 pounds. Okay. but we need to add our desired ending. Because that is just for production. So our ending is 15 and 1. Just as in the other budget, this becomes when you have whatever you need to produce plus your desired ending inventory is what the total needed is. We need 765,000 yards of fabric and 501,000 pounds of metal. From there, we take out our beginning because we had 10,000 here, we have 1,000 here. This is direct material to be purchased. Okay, so now we're going to know the amount of direct materials we need to purchase 755,000 yards of fabric and 500,000 pounds of metal. We multiply that by the cost per unit, which again, this, if you're doing a flexible budget, would be one you would want to leave open, so you can change around. But here's $2 per yard and $1 per pound, so times 2 times 1. And the bottom label is total cost of direct materials. 1510000 and 500,000. You would add those two together and write it out to the right of that. Okay. And sorry for being at home. My board is not big enough. But when you add those two together, the total you get, we're going to be moving forward just to be safe. You add those two together. Okay. So there's how much we are going to have to purchase in direct materials. Okay. So if you've written that out, keep that handy because that number will come back into play again later as everything else has as we work through these steps. Okay, so that is your direct materials budget. Again, that is on slide 16 on the PowerPoint. That was actually number 3, not number 2. Now we are on to number 4. The direct labor budget. Okay, it is another one that is very, very simple to do. Okay, so we know we have units to produce. So we calculated that we needed to produce 250,000 units from our production budget. This has to be a given to us here. How many hours, how many labor hours are needed to produce each unit? Well, it was given to us that it takes 15 minutes or a quarter of an hour to produce a unit. So we divide those to get our total hours needed of 62,500. Multiply that by the hourly wage, $24 per hour. Giving us a total labor cost of 1.5 million. The direct labor budget, as I said, is one thing you're going to need to be given is the hours needed per unit, and you're going to have to be given the hourly wage. So the more efficient you can be, this number can be changed also, and you would want to keep this one as a variable in your flexible budget to switch around. It's something that could vary. All right. Number 5. The schedule of manufacturing overhead budget. Remember, it's broken into two sections. We will have variable manufacturing overhead and we will have fixed manufacturing overhead. Okay. And we are producing 250,000 units. So if you note that on here, 4. The good thing about this one is everything is going to kind of be listed out. For the variable manufacturing overhead, you may have to calculate it based on the previous month, what it was, okay? The total cost was this, total units produced were this, so I can find my variable manufacturing overhead per unit. But I'm just going to, in our slides, we had stuff that creates variable manufacturing overhead. Indirect material, material handling, and indirect labor. Okay, so that is what you're going to be looking for, those three kind of broad categories. When you're looking for what's going to be included in variable manufacturing overhead, it was also given to us at, this was 15 cents a unit, this was 20 cents, and this was 50 cents. So when you add it out, that is 15 cents multiplied by the 250,000 units. Multiply the 250,000 all the way down times everything. I want to see something here because I know I wrote that number down right. I think I wrote that number down wrong. So our total variable comes out to 100,000. When you are doing one of these sheets for your homework or you're making one in your life, you are going to list out all of your fixed manufacturing overhead costs. You have to read through the problem and find out depreciation, probably a fixed cost. It's not changing. Okay. Manager's salary, rent, okay, insurance, all this bunch of different things. Anything you think that could be a fixed manufacturing overhead cost, list them out separately and then total them up. In this case, we got 600. Our slide said we had 525,000. So after you list out all your fixed, add them together, add it to your total variable to get a total manufacturing overhead. Okay. So that is step number 5. Okay, step number 6, we need to budget our cost of goods sold. Basically, you have done this before, okay? You're going to make a cost of goods manufactured statement, cost of goods manufactured sold statement using the numbers that we've just created. All right, we were given beginning work in process was 0. Underneath that, we start our manufacturing costs. You remember this is the cost of goods manufactured. Hopefully this rings a bell when we start going through it. Beginning inventory, 21,000 was also a given. Purchases, we would go back to our direct materials budget. There we calculated how much we needed to purchase. It was 2,010,000. Add those together to give us materials available, which is another line on this form. Save space, I'm going to leave it, but we take less ending. Our total direct materials about the 2 million. To that, we add the direct labor and the manufacturing overhead that we found in the direct labor budget, step 4, and the manufacturing overhead budget, step 5. We add those together. We get 4,125,000. We had 0 in our beginning working process, and it also tells us we have 0 in our ending working process. Okay, so if we had any ending working process, we would subtract it out right there, but we do not. The 4,125,000 becomes our cost of goods manufactured, our budgeted. Okay, remember everything I'm listing here in order to save space should have budgeted. Okay, budgeted purchases, less budgeted ending inventory, less budgeted beginning inventory. Okay, so there's our cost of goods manufactured. It is not quite done yet. Again, I ran out of room. Cost of goods manufactured was 4,125,000. We have 2 more numbers here that have to be given to us: beginning finished goods inventory and our ending finished goods inventory. Okay. 320. We add that to our cost of goods manufactured. That gives us our cost of goods available. We subtract from that how much was in our ending. Again, remember, we are budgeting based off all of our estimated numbers. That gives us our budgeted cost of goods sold. Okay, so those went together. Went to cost of goods manufactured. Then from there, plus beginning finished good minus ending, you get cost of goods sold budget. Okay, the selling and admin budget is on slide 20. I'm not going to run through this one. I mean, I'm going to run through it, but I'm going to do it very quickly. So what you want to know is you keep your selling and your admin separate. And within the selling and the admin, you would have variable and fixed. And then you would have variable and fixed. The hardest part is going to be going through and picking them out. If they're in there, stuff will be given to you. Add them together to get a total selling and a total administrative. So in our question here, our variable, we have sales commissions, and $1.50. Remember, we expected to sell 240,000. So $1.50 times 240,000 equals 360,000. We have other at 75 cents. 75 cents times 240,000 gives us 180,000. Total variable cost of 540. Our fixed were 350, giving us a total selling cost for the period of $890,000. Okay. So this is I have the variable cost of each, multiplied it by how many units we sold. Okay, because those are the selling costs. And our problem here, if we had variable administrative expenses, we would do the same thing. Our problem does not give us any variable. It says administrative is only fixed. Just as in the other ones, you would need to list them all, okay? You want to list all of them to get a total admin. And when we do that, the problem on the board gives us 796 as a total admin cost. And then you will want to go ahead and add them together because we're going to put it onto our budgeted income statement, which is our next step as a total. So when you add those two together, it is 1,686,000. See that? Total admin, and then another heading for total selling and admin together. Okay, and that is number 7, budgeting for selling and administrative expenses. All right, so now we are to our budgeted income statement. The top of the budgeted income statement is just going to look like our budgeted sales. So we have our sales units multiplied by our selling price to get our total revenue. From there, we take out our cost of goods sold, which we found back in 6, I believe it was. And we did our budgeted cost of goods sold statement. We got our selling and admin that we had just done in our last budget. And we get our budgeted operating income of $1,564,000. Take that number multiplied by our income tax rate, which is given at 25% for our income tax expense. And that becomes our budgeted after-tax profit of $1,173,000. If you look through the slides on chapter 13, all of these are laid out in Excel format. If you need to refresh your memory, I know there's a lot of it there, but all of it is really simple to go through. You just have to go in order because one builds off the other. Okay, so make your sales and then do your production and then do your direct materials and then your direct labor. Okay, then your manufacturing overhead. Okay, just work through the process. It's a little bit time consuming. In reality, you're going to build these for your company onto an Excel and you're going to leave all these variables open so you can just go in and start plugging in numbers. when stuff starts changing around, and you'll get the most accurate, ideal view. All right, so that's it for this video. Good luck. As always, if you need me, reach out to me. I will talk to you again in the second video soon.